Answers. That's what this is about. Today we're going to look at just 4 of the dozens of triggers we have. Now, let's turn to trigger number 1.
If buying the dip really works and is more than just a social media catchphrase, then there should be a trigger that triggers when to get long stocks, not when they're going down, but when they're going up after they've gone down. We don't want to buy the dip. We want to buy the rise after the dip, and we should see the results over tens of thousands of backtests with the best performing companies easily picked out.
For our second trigger, we're going to look at one of the most remarkable phenomenon we have ever seen in retail or institutional finance, which has persisted over the last 15 years, 2 bear markets and a bull market. But if this phenomenon exists, we need to prove it.
There must be verifiable entry and exit rules. There must be a technical indicator safety valve that learns to avoid the trade when the market changes direction, and the results must be empirical and explicit. And that's it. If non-directional option trading works, then again, there must be verifiable entry and exit rules, there must be a technical safety valve which learns to avoid a stagnating market, and the results must be empirical and explicit. And technical analysis. I mean, are we done drawing 100 lines on a chart trying to show that it works? Technical analysis is the most common form of financial backtesting. It is at every step using historical data to try to draw conclusions about the future. So if technical analysis works, fine. Which triggers exactly? Over which stocks exactly? And if it has worked, it should work over a bull market and a bear market, over the last 13 years, over the last 10 years, over the last 5 years, over the last 3 years, over the last 2 years, over the last single year. If it works, what are the indicators and how have they done? Answers. That's what we're about to see, and we're going to do it right now. We're focused not so much on buying the dip, but more on when to buy the dip. Our research looked at the last 1 year, 2 years, 3 years, and 5 years of returns. And after tens of thousands of backtests, we landed on 3 technical settings. We can go to the Pro Scanner, go by strategy. For these purposes, we'll just use the NASDAQ 100, though of course you can use this scan on any group of stocks you like. We'll go down under Never Trade Earnings to buy the dip. Technical. And now we're going to get all of the best performers from this trade. We can sort it by ticker, and we're going to see some of our favorite names. Apple and AMD, Activision, even Baidu. You can just click on the link and it will load in your trade machine. But while we're here, let's think about the types of companies that would perform well with this trigger. It would be companies that react heavily to macro news. Companies that have exposure to China, companies that have exposure to large momentum swings. So let's add Starbucks, which has a huge exposure to China, Cisco, which has huge exposure to China, Intel, which has huge exposure to China, and Netflix, which has huge exposure to momentum. And now we look over the last 3 years and we see the results. These trades can come in bunches and then go away. But for each of these stocks, the win rates are at a minimum of 60% and the returns are absolutely staggering. And you can go further with this. If you click on a backtest tile, you can see that the average return was 110%. And then we can pick out a trade. On February 12th, 2018, this triggered, and it closed on February 15th. The stock went from $162 to $172, and the calls went from $390 to $970 in 3 days. That's 150%. Now, let's look at that in a stock chart. This black line at the bottom is the 200-day moving average. This more volatile line is the 10-day moving average. We can see on February 12th, 2018, Apple stock had gone from below the 200-day moving average to above the 200-day moving average. And the stock price crept above the 10-day moving average as well. This was the trigger point, and this was the rally in just 4 days that showed 150% gain in the calls. You'll notice that Apple had been in a dip for quite some time. The question was not, is the stock going down? That's easy to find. The question to answer is, when historically has this downtrend turned into an uptrend? It seems easy enough when you look at a chart, but remember, in real time, you don't have a chart of the future. All you see is a stock collapsing. We can do a similar look with Roku. Again, the 200-day moving average is right here. The 10-day moving average is right here. The stock price was above the 10-day moving average already. But the day it crossed above the 200-day moving average was February 4th, 2019. And for the next 10 days, the stock ripped. And again, hindsight makes it easy. We can see the stock collapsing in the end of 2019. And you think, oh, well, this would have been the ideal time to buy the dip. But that's in hindsight. Remember, in real time, we saw the days coming. We never knew when the dip was going to end. You might have thought this was the end of the dip, and you would have seen another 40% collapse in the stock. The point is not to buy the dip. The point is to buy the dip when historically the dip is ending and the stock is returning to an upswing. We can go ahead and add Roku and even AMD into the backtester and see the results for those two stocks. If we click on the backtest tile for Roku, we will see this February 4th trigger and this February 15th exit, just as we saw on the stock chart, yielding a 53.6% return. AMD is another company that is hypersensitive to news out of China, so a buy the dip trigger hypothetically should be useful for the company.
And of course, the final step, but equally as important as trade discovery, is adding alerts for these events. So we'll click on the Add Alerts button. This will take us to the Alerts tab. Right now we're looking at Roku and AMD, but let's go ahead and add those other tickers that we looked at to start this demonstration. Apple, Starbucks, Cisco, Intel, and Netflix. This is a technical alert, and you can see the technicals are already set up for us. You can click the button just to verify it, but just clicking the Add Alerts button is going to get the exact trigger you want. We'll go ahead and put our email address in there, and I like to get text alerts in the middle of the day, so I know that these trades could be triggering at the end of the day, so put in the phone number. The link to the backtest is included as the alert, but I like to leave myself a note too. The note here would be buy the dip. Then I click Add Alert, and we have 7 new alerts created. We've done all of the work, and now Trade Machine will alert us when it's time for us to take notice of that work. And now we turn to our second trigger, which is simply a stunning phenomenon we have come across. We can't cover it fully in this video, but as a Trade Machine member, you get full access to the research, to one of the most remarkable phenomena in public markets we have ever seen.
By now, the rest of the world has picked up on our published research that there has been, in the last 10 years during the bull market, pre-earnings optimism, in particular in technology companies. We're talking about this period right before earnings. We're not talking about what happens after earnings, but there has tended to be pre-earnings optimism a week or 14 days before earnings, where owning calls and then selling them before the earnings event has been a fantastically good trade. Let's just take a look at how good it has been. We'll look over the last 10 years. We'll look at Microsoft, Google, and Amazon. We'll look at buying a call. We will do it with custom earnings timing. That is, we will open the position 7 days before earnings, and we'll close it the day of earnings. Since all 3 of these companies report after the market closes, this trade does not take an earnings bet. If these stocks reported before the market closed, then we would have to put a 1 here. And here are these fantastic results. We can see across the board from Microsoft, Google, and Amazon, just staggering results. 340% to 497%. The win rates are all above 60%. But there's a fair criticism which says, sure, if we could guarantee that we would be in a bull market tomorrow, then we could put this trade on today. But we cannot guarantee if we're in a bull or bear market. And the end of 2018 has been a perfect example of how quickly things can turn. So let's take this exact same test and let's just look at what happened over the last 6 months. And what do you know? All 3 of these have now turned into losers. So does that mean this pre-earnings optimism that we talked about before, does that optimism no longer occur? Or if it does, how do we know when it's going to occur? We're going to apply a technical trigger. We will go down to a technical open. We are going to do the same trade, but only if the stock price is above the 50-day moving average. For those of us that are more visually inclined, this is exactly what we're doing. We're waiting for the 7 days before earnings. We're checking to see if the stock price is above the black line. The black line is the 50-day moving average. Since it is, that triggers an entry, and that is the momentum we seek. We fast forward 1 earnings session, and again, we look at 7 days before earnings, but now the stock price is below the 50-day moving average. It's below that black line, and so no trade is taken. That is our safety valve. And here are the results now. Even over the last 6 months, you'll notice that one of the earnings was skipped. You'll see each of these stocks only have 1 trade, even though there have been 2 earnings in the last 6 months. And which trade was skipped? We can just click on a backtest tile. We can see the only trade placed, for example, Microsoft, was in summer. We applied a simple rule, and now we can compare these last 6 months using the technical indicator without the technical indicator. And here they are side by side. Look at the difference that just eliminating 1 trade has had. But now, let's look at the impact of this little filter over the last 10 years. That is, what if we used this technical open, that is, trade the 1 week before earnings, if and only if the stock is above the 50-day moving average, but let's do it for the last 10 years. And here are those results. And since we're dealing with a lot of numbers here we include the results without the technical trigger. To make things easier to read, we'll just show the total return of the back tests and the win rates. First we found the pattern, and then we found the safety valve. Using the simplest of technical opens, we have seen higher returns using just one of the phenomena that we have identified that exist in the market during both a bull and bear market. It turns out that we can also look at the 14 days before earnings for this pre-earnings momentum. So we have 3 days, 7 days, and even 14 days. And how do we find all these ideas? How do we know which stocks are working the best? That goes to the Pro Scanner. We'll click on Pro Scan. We'll select by strategy. We will choose a ticker group of the NASDAQ 100. And you can see there are so many scans that we have for idea generation. But in this case, we're focused on the pre-earnings scans, and we're looking at pre-earnings optimism. So we have the 7 days, 14 days, and 3 days pre-earnings optimism calls. Not only do we have the 3-day, 7-day, and 14-day pre-earnings long call, we also have the 3-day, 7-day, and 14-day pre-earnings long call with the technical requirement imposed on it. That is, those trades are back-tested and scanned if and only if the stock price is above the 50-day moving average. So you can see, even for the single type of trade, we have 6 different scans to find the best of breed. While we're here, you notice that we also have pre-earnings volatility plays, looking to own a straddle just to capture that rise in volatility and then closing it the day before. You can always just tap on a ticker in the scanner and it will bring up the backtest tile and show you those results in the backtest tab, where you can customize it further. And finally, no backtest is complete without setting the alert. So I go to the alerts tab. I'll add 2 tickers. I want to look at NVIDIA and Workday 3 days before earnings. For the alert type, I'm not going to go days before earnings, but rather I'm going to go days before earnings with technicals. I want the alert to be 3 days before earnings. And the technicals that I want to set, I'm going to click this button, are that the stock price is above the 50-day moving average. Then I add my email address. And I actually like getting text alerts for these things too, so I'll enter my phone number. And then I'll add some notes. And then I'll add the alerts. So we have found the answers that we sought for momentum trading. We found a verifiable entry and exit rule. It was absolutely structured and methodical. We found the technical indicator safety valve that learned to avoid the trade if a bear market or a correction was starting. And finally, the results were empirical and explicit through a bull market and a bear market. And now we'll turn to non-directional option trading. It can be shown that just blindly owning calls and puts, that is straddles or strangles, is simply a losing strategy. I mean, how wonderful would option trading be if you could just buy calls and puts every 2 weeks and make money? But you can't, and we can actually show that. Let's look at the period from 2015, September 30th, through 2018, September 30th, and simply get long a strangle, doing nothing special with earnings, and doing it every 14 days in Amazon, Adobe, and Facebook. And here are the results. Even in a raging bull market, this strategy has been a complete disaster. But here's the secret. There are specific times when just owning calls and puts together and betting on option volatility is a good trade and avoids all of the risk of a bear market or any directional bias. But it must be extremely selective, and when done properly, the results are staggering. The specifics behind this strategy are reserved for Trade Machine members. And here are the results. You can see with Amazon, 4 wins and no losses, or PayPal, 8 wins and 2 losses, or Facebook, 4 wins and 1 loss, Adobe, 3 wins and 2 losses. And note, this is taking no stock direction risk at all. It's just waiting for a trigger that indicates volatility so we can look at a non-directional trade. But let's look at how this trade did during the bear market of late 2018. So we'll go into our settings, we'll put in the beginning of October 2018 through the end of 2018. And you can see here in just those 3 months where the market was collapsing, we have 2 trades with Amazon, 2 wins, no losses with 96% return, while the stock was down 26%. There was no trade in Facebook because the safety valve, the technical requirement, didn't trigger. That's exactly what we'd hope to see. Now let's look at the results over 10 years. And while we're here, we added Apple to the fray as well. Now you can see, over 10 years, 12 wins and 1 loss in Amazon, 13 wins and 7 losses in Adobe, 7 wins and 1 loss in Facebook, 8 wins and 2 losses in PayPal, again 8 wins and 2 losses in Apple. Through a bull market and a bear market, taking no stock direction risk at all, we turned a strategy which has been shown to be a loser. That is just owning calls and puts and hoping that stocks will move. We added a few rules with backtesting and found magnificent results that work during a bull market and a bear market, And where do we find historically the best candidates for this volatility trade with a technical trigger? It's under the Pro Scanner. So we'll click Pro Scan. We go by strategy. We can choose any ticker group we like. In this case, we'll just choose the NASDAQ 100. And here we go for the Never Trade Earnings scans that we have. And we're looking at the technical long strangles. And you'll get all of the results. And finally, we can go to the Alerts tab and set an alert.
And now we cover technical analysis and wade through the suffocating confusion that surrounds an area of study that deserves true empirical research.
Does technical analysis actually add value to trading? Are we doing anything more than just drawing lines on a chart? Well, we tested technical triggers, and we found one for bullish momentum and for bearish momentum that outperformed the baseline, that is just owning a call and rolling it, or owning a put and rolling it, from the period from 2007 to 2009 that included the Great Recession, then the last 10 years, the last 5 years, the last 3 years, the last 2 years, and the last year. We're talking about over 250,000 backtests, over 5 million data points. And while the specifics to that research is reserved for Trade Machine members, we can show you the results from a few stocks. Here we look at NVIDIA and AMD, Cisco, Google, and Applied Materials. And here are the results over the last 3 years where we apply this special technical open. And you can see the win rates in NVIDIA, 7 wins, 1 loss in 3 years. Across the board, we're looking at win rates above 55% and as high as 87.5%. We're looking at total returns as high as 742%. But why are we looking at 5 stocks over 3 years? Let's look at the entire NASDAQ 100, all of the constituents over 13 years. That research is reserved for Trade Machine members. An empirical analysis really does go further than just drawing lines on a chart. And we found a separate trigger for bearish downtrends, which also outperformed the baseline of just owning a put during 2007, 8, and 9. During the last 10 years, 5 years, 3 years, 2 years, and 1 year, looking at hundreds of thousands of backtests. And again, that research is reserved for Trade Machine members, but it's available in the Pro Scanner. We just click Pro Scan, we go by strategy, we can choose any ticker group we want, but we'll use the NASDAQ 100, and here it is. It's the bullish technical bursts or the bearish technical bursts. With one click of a button, you find the companies that have worked over the last decade and longer, and how technical analysis added value to trading. Yes, we have addressed the elephant in the room.
We set out to demonstrate 4 triggers, and we have been successful in that.
We were empirical and explicit, and we hope that you were better for it. Of course, there are so many other strategies that can be tested, and among those strategies, you'll find your favorites for a diversified option portfolio that works during a bull market, a bear market, and in a chop market. And we cover every stock and every ETF and every index in North America. We were empirical and we were explicit, and we did answer the questions that we set out to. Thank you for watching. We hope you're the better for it.